While the mainstream media has you watching the stock market, a silent tectonic shift is happening right under our feet. It's in the silver market, and honestly, it's a story with the potential to rewrite the rules of global finance. We're going to break down what's really going on, because the signals coming out of the East are too big to ignore.
And it all starts with this. Now, when you hear a phrase like unprecedented, it's easy to tune it out as just more market noise. But this is different. This is a flare going up, signaling that the actual physical supply of one of the world's most critical commodities is under extreme duress. And that has consequences for every single one of us. So what is this unprecedented event? Well, it's not some abstract financial maneuvering. It's a huge, systematic draining of physical silver bullion from warehouses in China. We are not talking about a little bump in demand here. Think of it as a bank run, but for a crucial industrial metal, and it's happening at a pace that has completely caught the market flat-footed. That brings us to the first part of our breakdown, the vanishing silver. Because that's literally what's happening. The metal is disappearing from the vaults, and we need to understand where it's going, and more importantly, why. Okay, look at this. This right here is the smoking gun. In Shanghai, to get your hands on actual physical silver, you're paying around $82 an ounce. But in New York, a paper contract, basically an IOU for silver, is trading for less than 80. Now that little gap, that isn't just a pricing quirk. That's a crack in the very foundation of the global market. It's the market screaming that the promise of silver is no longer the same as the real thing. So you have to ask yourself, how did we get here? Did this just happen by accident? Not a chance. What we're seeing is the result of a very deliberate, very calculated plan. Let's call it China's fortress strategy. You see, this didn't happen overnight. It was a slow, methodical squeeze. If you look back 6 months ago, everything was normal. But then, in the fall, Chinese manufacturers started buying up supply way ahead of schedule. By October, you could see the inventories in China just begin to nosedive. And then came the final checkmate move. On January 1st, Beijing effectively sealed the exits, trapping all of its domestic silver supply inside the country. They built a fortress. And this is why their actions have such a massive global ripple effect. China isn't just a buyer, they are the world's refinery. They control a staggering 60 to 70% of all silver refining. That means metal pulled from a mine in Peru often has to go through China before it's usable. They are the gatekeeper for the entire global supply chain. So you have this fortress of physical metal being built in the East, and at the same time, the vaults in the West are looking more and more empty. This brings us right to the heart of the conflict, the epic battle between a world of paper promises and the cold, hard limits of physical reality. Now, to really understand the stress in the West, you have to know this one simple but absolutely crucial distinction. The big COMEX vaults in New York have two kinds of silver. There's eligible silver, which is just metal people are storing there. It's not for sale. Then there's registered silver. That is the pile that is actually available to be delivered to buyers. It's the only number that truly counts. And here's the kicker. That pile, the for sale pile that backs the entire global paper market, it's fallen off a cliff. We are talking about a 70% collapse in the amount of silver that is actually available for delivery. The shelves are going bare at the worst possible time. Normally, the market would fix that price gap between Shanghai and New York. Traders would buy the cheap paper contract in New York, take delivery of the physical metal, and ship it to Shanghai for an easy profit. But that mechanism, it's called arbitrage, is completely broken. Why? It's simple. You can't ship metal that you don't actually have.
Okay, so you might be thinking this is a problem for some Wall Street traders. But here's where it starts to affect everyone. Because silver isn't just a financial asset, it is the absolute bedrock of modern technology. And that's where the real squeeze is just beginning. Think about it. Solar panels, electric vehicles, your smartphone, the entire power grid. None of it works without silver. For these massive, multi-billion-dollar industries, getting silver isn't optional. It's a non-negotiable requirement to keep the lights on and the assembly lines moving.
This creates a powerful force that economists call an inelastic bid. In simple terms, it means when the price goes up, these industrial giants don't buy less. They actually start buying more aggressively. They panic. Because the cost of shutting down $1 billion factory over a few $1,000,000 worth of silver is a price they absolutely refuse to pay. They'll pay anything to secure supply.
And that is the critical difference between what's happening now and past silver spikes. Those were often driven by financial speculators. And you know what? Speculators can be scared off. You can raise margin requirements and crush them, but you can't crush a factory. This demand is real, it's relentless, and it's not going away. So, you see the pieces on the board. You have a fragile paper market built on a shrinking pile of physical metal. And you have an unstoppable industrial demand that is getting more desperate by the day. These two forces are on a collision course. Let's just boil it all down. It's this simple. A financial system built on paper promises and leverage is slamming head-on into the wall of physical scarcity. And that wall is being pushed forward by an industrial necessity that, frankly, doesn't care about paper prices. It just needs the metal. And here is the final, crucial piece of the puzzle that almost everyone misses. Unlike gold, which is hoarded and recycled, industrial silver gets used up. It's dissipated in tiny amounts into millions of products, and it's gone forever. Every ounce that goes into a solar panel is an ounce that will never, ever come back to the market. This deficit is permanent. All of this leaves us with one final chilling question. When a system of paper promises is stretched this thin by physical reality, when the foundation cracks, does it bend and adjust quietly? Or does it snap all at once in a sudden, violent repricing? That is the question the market is holding its breath to answer.